everyone, welcome back to our video series for financial planning for dental practice owners. Today we're going to be talking about some different types of retirement plans and why they're important for your practice and terms that you need to know. The options you have for retirement plans are vast. It's usually an alphabet soup, and more times than not, the easiest path is sometimes not always the best path, and we'll go into some details on why that's important to know. First, when deciding on a retirement plan, it's very important you meet with an advisor, CPA, who specializes in working with practice owners, because making the decision on deciding on the right retirement plan for your practice can really set you up to succeed not only for your personal financial planning, but also provide a tremendous benefit for your staff and your team as you look to remain competitive in the marketplace. So there's four main plans that I want to talk to you about today. The first is a SEP IRA. The second is a simple IRA. The third is what you've probably most commonly heard as a 401k plan. And the last is a defined benefit cash balance plan. Each of these plans offer different benefits, have different rules, limitations, all the things that we're going to talk about today in helping you decide which plan is right for you. So the first plan that I want to talk to you about today is called a SEP IRA, or a simplified employee pension plan. And it is an individual retirement account. It's extremely easy to set up and administer, and it's usually one of the most popular plans that you'll hear as a recommendation because it's easy to administer and there's almost no administration costs. So some of the rules around this is that when you set up a SEP IRA for your practice, only the employer, meaning your practice, can contribute to the plan. So if you have any employees, they're not able to put their own money in. The only money that goes into this plan is going to come from the practice. Now, one of the ways to get money and the limitations around putting money into this plan is that you have the ability to put up to 25% of your compensation into the plan, up to a maximum in 2024 of $69,000. Sounds like a great plan, sounds really easy. However, one of the unintended consequences of that is whatever percentage of your own compensation that you put in for yourself as the practice owner, you have to put that percentage of your employees' compensation into that plan if they're eligible. And most employees in a SEP IRA, especially if they're full-time, are going to be eligible. So again, it sounds great, it's very easy to set up, simple to administer, but you have to be very careful that you don't set yourself up to put in a significant amount of contribution, more than maybe the practice could afford or you'd like to have part of your compensation plan for your employees. The second plan I want to talk to you about today is called a simple IRA. And simple IRAs are really great, especially for practices that are just starting out, that don't necessarily have the profitability to put large sums of money away. One of the benefits of a simple IRA is that both the employer and the employees can defer money into this plan. It is very easy to set up and there's little to no administration costs. You go right to a custodian and set up a simple IRA. It's very straightforward. Now, it does have some limitations on how much you can put away. So, for example, an employee or yourself as a practice owner can put away up to $16,000 in 2024 plus a $3,500 catch-up contribution. It's really attractive. Now, one of the caveats is that the employer will have to put in a simple IRA for their employees at least 2% as a fixed contribution of their compensation, or provide a match up to 3%. So again, it's really important if you set up a simple IRA plan like this to make sure that you budget for any compensation that you are going to have to put in on behalf of your employees in setting up this plan. So far, we've talked about two types of plans, SEP IRAs and simple IRAs. SEP IRAs maybe not ideal for practice owners. Simple IRAs great potentially for ones just starting out. Now, the next plan, a 401k plan, is probably one that everybody's heard of. You may have had one in the past if you were an employee in another practice. And 401k plans are typically more expensive to administer and a little bit more complicated. They are employer-sponsored plans, and they do require additional administration. So oftentimes, sometimes it could be a little bit of a burden on whether or not a practice wants to implement one. Now, there's also a lot of benefits that come with that administration, though, for practice owners. One, higher contribution limits. So unlike a simple IRA where you can only put up to $16,000 of compensation plus $3,500 if you are over age 50. In a 401k plan in 2024, you could put up to $23,000 in your 401k plus an additional $7,500 if you are over age 50. So again, higher contribution limits, additional ability to put money away for your retirement. Now, in a 401k plan, both employees and yourself and the practice can put money in. So if you were to design a plan that allows yourself to maximize how much the practice puts in on your behalf, you can put up to $69,000 or $76,500 into a plan on your behalf for 2024. So again, tremendous benefit that comes with that additional administrative burden. Now, certain 401k plans, there's different type of plan design. This is where it's really important that you're working with a team to decide on plan design for the 401k. Unlike IRAs, which are very boilerplate, you can customize a 401k plan to tailor your practice's demographics and decide on a budget of how much you want to put in on behalf of your employees. So that way you go in eyes wide open of all of the costs and all of the compensation benefits that you'll provide for your employees. It's really important for planning for your profit and loss statement for the course of the year. Using a 401k plan is a great benefit. It's also really important how much you can minimize that administrative burden. Working with a team of professionals like a financial advisor and a CPA who specializes in working with dental practice owners, you're also going to want to work with some of the most technologically advanced 401k providers out there. We work with a number, and more importantly, you want to make sure the two key pieces that are in place are your 401k record keeper and custodian. They're going to be managing the money and the investments and holding those accounts. The second is going to be a payroll provider that's going to integrate with that 401k plan to make it seamless. So you're not cutting salary deferral checks, you're not keeping track of everything. Most things are all turnkey for you and your employees in managing the plan. Now, the last plan I want to talk to you about today is called the Defined Benefit Cash Balance Plan. And it's a type of retirement plan where only the employer is putting money into the account. And one of the biggest benefits, albeit it is usually more complicated and expensive to administer, is that you can shelter hundreds of thousands of dollars into this plan if the compensation is right. It provides the highest contribution limits, unlike your SEP IRA, your simple IRA, or your 401k plan. And most of our practice owners actually combine a 401k plan and a cash balance plan. Typically in the timeline or the life of a practice, most practice owners are putting in this type of plan post age 50. They've been able to save a considerable amount of money, and their practice is very profitable, and they want to shelter and put away as much as they can for retirement as possible. Typically, this involves a lot of tax planning. So again, this type of plan is extremely powerful in maximizing benefits for your own retirement. Now, the way this plan works is the contributions go in only from the employer. Employees do not put any money into this type of plan. And what it does is it promises a fixed amount at one day in retirement. Now, each amount of dollars goes into this plan, which is a percentage of an employee's compensation as a pay credit, plus an interest credit that goes into the plan. One of the most important things in thinking about a cash balance plan is working with a professional and an advisor to come up with what your budget is for your overall retirement plan. These can all be customized and tailored to fit exactly the type of objectives that you're trying to achieve. And more importantly, we'll be able to show you in advance of you implementing any type of plan what you can actually do and what you could put away to make sure it makes sense for you. So in summary, we've talked about 4 types of retirement plans today. A SEP IRA, which is probably not a great idea or plan for practice owners. A simple IRA, which is great for practices just starting out or for owners that are traditionally not interested in putting a lot of money into a plan. Third, a 401k, which is the most popular and most common type of retirement plan. And fourth, for our most sophisticated practice owners, a cash balance pension plan. Thank you for listening today. I hope the information we provided today was helpful. If you're interested in a free analysis of your current retirement plan or thinking about implementing one for your practice, please head over to our website and set up a free initial consultation. And it's something that we provide for all practice owners as a free analysis.